Hi there. Thanks for tuning into our podcast. I am with Chris Picciurro today. Chris is a certified public accountant. He's an expert in tax planning and strategy for real estate investors. His CPA firm designed to work with real estate investors and high income earners. Chris is also our preferred CPA partners. Chris, welcome back.
Oh, it's great to be back, Arda. Thank you for having me. And this is one of my favorite subjects when we talk about short-term rental properties.
Yeah. So, as an investor, I do believe that underwriting is the most crucial skill in real estate investment. Accurate and comprehensive underwriting is vital to mitigate risk and grow your real estate portfolio. Unfortunately, I'm running into investors who are making big underwriting mistakes quite often. They typically underestimate expenses or overestimate revenues. That's the number one mistake that I see in underwriting. The second mistake that I see is not running different financial scenarios based on revenue and expenses. Most of the investors rely on simplified online calculators or realtor numbers. So what happens is that they end up buying a property that doesn't cash flow, and all of a sudden they got a big liability on their hands. I am probably one of the most impatient, kind of people out there. But when it comes to real estate, I'm very diligent and careful with underwriting, as you know, Chris.
Yes.
So today, I really wanted to delve into underwriting with you and explain how we, mitigate risk and help investors make a great, investment property decision. So my first question is, what is underwriting in real estate investment?
Right. And that's a good point. So when we think about underwriting, we typically think about the loan process, meaning there's a bank underwriter underwriting that mortgage, making sure that the bank's going to approve it. But as you are saying, based on my experience working with short-term rental owners on a daily basis on the tax planning and strategy side, investors should underwrite their own deals regardless if a bank's going to loan you money or not loan you money. Just because it passes through bank underwriting doesn't necessarily mean it's a property that's going to be viable for you. And like you mentioned, you've got to think about different types of monetization strategies, not just short term, but what happens if something does go awry or laws change or rules change, or if it's a seasonal rental, do you want to factor in a snowbird or something? So underwriting the deal, making sure it makes financial sense to you. We know there's a huge, huge tax advantage to the short-term rental loophole, to implementing cost segregation studies, but making sure the tax tail isn't the only thing wagging the dog, and making sure that the gross revenue that you project for the property is going to cover all of your debt service, all of your expenses, and maybe even put some money into your pocket is number one. So gross revenue test, when we're talking about long-term rental properties, there's the 1% rule, which is really hard to find now, right? Because, but when it comes to short-term rentals, you need that gross revenue number to be 15 to 20% of the purchase price in general, right? And that's what we're seeing that our clients are looking for, that magic number. And obviously that can vary based on interest rates. Our clients talk all the time that you date the rate, you marry the property. But first step is literally look at that gross revenue test and try to hit that number. So for instance, a property let's say it's a $1 million property, you're going to want to see it doing $150,000 to $200,000 of gross revenue, because you're understanding going into number two that short-term rental properties, and this is, by looking at tax returns and talking to our clients a lot, the operating expenses for short-term rental properties are higher because you're turning it over. You have more, not just the linens and the sheets and everything get used, but you also have more cleaning, right? You probably have more electricity usage because someone's in and out of the property and they're not paying the electrical bill, right? So you have to factor that in. Now, that doesn't say don't buy the property. All it's saying is making sure that you're trying to keep those gross revenue, you're trying to keep your operating expenses, and this is from, in general, rule of thumb, between 40 and 50% of the gross revenue. So you start with that gross revenue figure. You want to hopefully put, 50% of margin, because there are going to be vacancies. There are going to be things that are outside of your control. And then really, to me, the one underwriting piece that that the banks look at the most that you have to look at is your debt service ratio or debt service test. Do you have enough cash available from the property to service the debt right now? We know that interest rates are a little higher now than they were a few years ago. We hope that, and obviously you would be able to refinance in the future, hopefully, if you have the right, and that would obviously help your operating expense and the debt service test. So the way I look at the underwriting, what we're hearing from clients is that you've got a test based on sales, which is your gross revenue test, and then you really have then you really have two tests based on your expenses, which are the operating expense ratio and the debt service test.
No, this is great info. Let me ask you this. What are the benefits of leveraging a specialized real estate CPA for underwriting?
Well, obviously, if you're someone that's going into short-term rental properties, if you're someone that is an operator that you own several properties, you've probably already established a relationship with a CPA firm that's familiar with that type of client. So for us, we work on our private CPA practice side. Ultimately, we work with almost all real estate investors and some entrepreneurs. So when we interact with our private CPA firm clients, we're talking to people that probably already own several properties. Now, for the first-time property buyer, I think it's important to talk to a tax professional in that process of buying the property, because ultimately there's that tax benefit, right? That tax benefit is going to offset greatly a lot of the costs or a portion of the costs associated with your startup costs, your down payment, your furnishings, your fixtures. But also, having someone that, now, the CPA is not going to be able to guarantee, no one can guarantee that the property will rent out. Obviously, a lot of analysis goes into that, but assuming that these assumptions are correct about the property, making sure that those ratios are hitting. So understanding like that, yes, if I buy a property for $1 million, for these numbers to work, talking to someone that understands what $150,000 to $200,000 should be your target on that property is very important.
No. These are invaluable, kind of information. Thank you so much, Chris. So let's recap, our conversation and what you said. So first and foremost, underwriting plays a crucial role in the success of a short-term rental investment. Accurate and comprehensive underwriting is vital to mitigate risk and build a solid, profitable real estate portfolio. As an investor, you have to understand all aspects of your investment, from operating expenses to net income. You cannot properly underwrite an investment property by relying on online calculators or realtors' numbers. By accurately estimating revenue and expenses, you can make informed decisions and set realistic expectations. You should also underestimate revenue and overestimate expenses to account for potential fluctuations. Based on my experience, this conservative approach helps you mitigate risk and ensure the long-term profitability of your properties. As always, if you'd like to learn more about our services and short-term rentals, check out our website, strtaxloophole.com, or drop us an email at team@strtaxloophole.com. Thank you, and see you all on the next episode.